Hi, I'm Mal from the Money Study, bringing you another episode in our Take 10 challenge. And we're up to number 17, all about those wonderful bits of plastic called credit cards. Before we kick it off, there's the disclaimer: facts and figures, information only. This is not advice. Well, I think pretty everyone knows what a credit card is. It's just the fact that a lot of people sort of bury their head in the sand when it comes to these things if they don't intend to use them correctly. Um, it's just the fact that credit cards have got one of the highest, probably the highest apart from payday lenders, interest of anything as far as any sort of debt is concerned. The credit card has debts and interest rates in excess of 15% generally, and can be certainly over 20%. Now, if you're paying 20% on a debt, ouch! This is really hurting. Now, of course, they can be handy in the regard that we can indeed use them to pay the bills with and so forth, and iron out our fluctuations in our expenses. But this is where having your little bit of a buffer in your bank accounts, so that you can indeed do not have to rely on drawing out from a credit card if you cannot pay it back within the month. Now, I use a credit card or a debit card, whichever sort of at the time, but it basically comes down to, yep, every single month that thing is paid out. I'm not going to give the joy to the bank of it actually extracting interest out of me from a credit card, that is for sure. I think it's obscene, quite frankly, that they can charge that sort of amount on a credit card, but then of course we're still, a lot of people only getting 3 to 4% on their savings account, and of course before that we're down 0.5% on savings account a few years ago there. So it's a criminal thing. Banks love them. They issue them out like candy to a child, but we've just got to make sure that we are the ones in control here, not the bank. So obviously it just simply means that if you put something on credit, you've got to pay it back, and the interest on that amount, if it's outstanding at the end of the period, at the end of the month when your bill's due, you basically have to pay interest on that amount of money. So we're trying to get rid of it, pay off the debt every single month. Now, some have don't even have an interest-free period. So you're really paying interest, from day one, or from when the statement is issued. So make sure you do indeed have an interest-free period, because we don't want to get caught up into having a credit card that instant we use it, we're paying interest on it. And of course you can, I love that word can actually get a cash advance, so you can stick your plastic into the ATM and pull out some cash on your credit card, but interest is indeed paid immediately on a cash advance. Now, if you've got to pull cash out of a credit card, you've got a problem. You have got a problem. Where is your emergency funding? Where is your buffer in your bank account? You should not have to draw cash from a credit card. And if you're doing that on a regular basis, go back to listen to some of the first episodes we've done in this to really reinforce what you are doing. Because what you're doing here is you're adding debt to something at a ridiculously high interest rate. And therefore it becomes exceedingly difficult to dig yourself out of a hole if your credit card is indeed getting bigger and bigger and bigger. I always remember I had a lovely lady. She came in to see me, and she had $93,000 worth of what I'll call short-term debt. Bulk of it was on credit cards. She had store cards. She had a personal loan unsecured, and she had, a few other little bills and things from friends and so forth. $93,000 of higher interest payable. And of course, when she was explaining it to me, I'm sort of starting to go pale, thinking, how in the dickens am I going to help this lady? We got talking about all of our other situations just to confirm, and found out that she actually had $87,000 sitting in a term deposit. And I said, oh, quick, run down to the bank, pay the break fee, get the money out of the term deposit and pay off your credit cards. And she turns around to me and she said, oh, I couldn't do that. And I said, why not? And she said, well, it's taken me ages to get that the money into the term deposit in the first place. And I said, no, of course it did. You're paying all this high interest rate on your credit card. You don't have $87,000 in a term deposit. You've got 93 in a credit card. You're minus $6,000. No, you've got to think of it in your overall situation. Which one are you paying the highest interest rate from? And if you've got investments that are making you, especially on a term deposit, when I spoke to her, it was about 3%, and she had to pay tax on it. She's making a bit over 2% on this term deposit, while she had credit card debt on the other side of nearly 20. Now, I didn't think anyone could be that, I won't say dumb, but really, honestly, that really doesn't make any sense at all. So look at your overall situation. If you've got credit card, but do you have other assets that you could indeed sort of reduce at least some of this credit card debt? You see, if you had, and I get people who just pay the minimum, It says on their statement they've only got to pay X. If you're in that situation, you have got to get yourself together. You can't just keep on paying the minimum. If you had a $4,400 owing on your credit card, and then just pay the minimum that they tell you on your statement, it takes 31 years to pay it off, and you've paid $12,924 interest. Now that's a quote I got directly out of the Barefoot Investor. I'll say it's a pretty reasonable book for scaring the daylights out of you. But yeah, it's just insane to take 31 years to pay $4,400 and then pay triple the amount of money overall because you're paying all this interest. Then I get the people with credit cards that have got the frequent flyer, got all these rewards points, and they say, oh yeah, but yeah, look, I've just got all these rewards, and I got a flight to Melbourne out of it, and I'm thinking, how much money are you spending on your credit card to do this? And did you really save money by using a credit card to get flyby points or frequent flyers or whatever it might be? You need to spend $22,000 to get a $100 gift card. $22,000 to get a $100 gift card. And of course, it comes down to most of those ones with rewards points, the actual credit card costs are even higher. If you really are going to get a credit card, this whole business of the frequent flyer, you've got to spend that amount of money. Really? Do your numbers as to what that really means. As far as what it's costing you in fees, especially if it makes you go over in a month and you've got to pay interest on top of it. No, look, I'm sorry. That just doesn't make sense. Luckily, for people who are a little bit lacking in self-control, dare I say, since the 1st of January 2019, when anyone new applies for a credit card, then the provider has got to assess that the person who's applying can actually repay the full credit limit within 3 years. So if you've got a $10,000 limit on your card, that's all you can borrow on your credit card. You've got to prove that you could pay 10 grand off within that 3 years. Is that enough? Look, it's probably a start compared to what it was before. They used to give credit cards effectively to anyone with a pulse. And remembering, of course, if you ever do go for a loan, then the bank will always look at what your credit card limit is, not how much you've got on it. So if you've got a $30,000 credit card limit and you're applying for some other loan of some form, they'll assume that you have got a $30,000 worth of debt on your credit card, even if you pay it off every month. So if you're going to apply for a loan, it may be quite sensible to reduce your credit card limit down to $2,000 or whatever it may be, just to get you through the few weeks or so. Get the mortgage approved. This is just obviously if you find it a bit tough to get the loan, and then you can always go back to get the increase on the credit card. Once you've got the loan approved, they won't care, which is really quite bizarre. Why not? So anyway, that's the theory. At least, well, I suppose they could still got to prove if you take the mortgage out, can you afford to pay the credit card limit off over 3 years? I suppose that's the clarifier there. But I hate the banks. I used to work for one. It was the worst job I ever had in my entire life. That's saying something. I've had some doozies over my lifetime. I hate banks with a vengeance. They've got to basically, we still have to use them, but annoy the bank. Pay the credit card off every month, and obviously we can use a debit card. And we might talk about debit cards in another session, but debit cards effectively, it's just using plastic. Still can use it online and flash it around, but instead of we're not borrowing money, we're just using the process to withdraw money from our savings account, so from the whatever associated account is to that debit card. So no interest applying to debit cards. Fascinating things, credit cards, but yes, look, people I've seen who literally borrow money from one card to pay the minimum repayment on another. You are in desperate straits if you're in that situation, and you've got to just chop it up and work out how the dickens are we going to get out of this hole. Now that I've cheered you all up, good luck, and we'll see you again on another session.